Welcome to the Corporate Venturing Insider Series, where I interview top practitioners in the CVC world and learn with you the best practices and golden nuggets that they have accumulated over their careers. This week, you will be hearing a conversation I had with Angela Lee, founder of 37 Angels and professor of venture capital at Columbia Business School. Angela, could you take a few minutes to share your story and how you got to where you are today?
Yeah, so my journey has been one of a path of happy accidents. So I was a founder first. I went to UC Berkeley, I graduated during the first dot-com boom. And so, of course, started a company because that's what you do. And then went on to be a product manager. And then I thought I was going to stay an entrepreneur forever. I went to Columbia Business School for my MBA, and then I graduated and became a McKinsey consultant because that's totally the same thing as being an entrepreneur. And then re-entered the entrepreneurship space a little bit later. I was an angel investor first, started 37 Angels, which I could talk a little bit more about. And then maybe 8 years ago, a venture capital firm started reaching out to say, "You've been doing well as an angel. Would you like to join VC as a venture partner role?" But very much not intentional.
Happy accidents, like you said. Actually, I think you're the first one to mention you graduated during the dot-com boom. So maybe you can share a bit of context. Everyone reads about it, but what was it like graduating during that time?
So I think the pros were that it really felt like the world was full of possibilities and literally the internet was being born and new ways of shopping and discussing and interact with people were changing on a monthly basis. And so it was a really great time to be working and starting companies in such a time of possibility. On the other hand, there was no roadmap of how to do any of this. How do you fundraise? How do you build a pitch deck? How do you build an MVP? None of that existed. So we were all figuring it out on our own. And it was a lot of the blind leading the blind. And so I'm really grateful I started my first company when I was 19 because I feel like I had the exuberance of youth to not realize I had no idea what I was doing. It was me and three co-founders, all from UC Berkeley. And we knew we were very young to be starting a company. And so we had 3 sets of business cards. I had a business card that said I was the director of marketing, VP of marketing, and chief marketing officer, all of which were true because it was just me running marketing. And the more senior the client, the more junior of a card we would hand them. Because if I handed someone the CMO card, they'd be like, "You should not be the CMO of anything." But if I handed them the director of marketing card, they'd be like, "Oh, well, then my assumption is that there's somebody managing you." And it was one of many things that we did, which were very silly. But again, we were learning by doing, learning by throwing spaghetti against a wall.
I agree, that's a cool hack.
Yeah. I don't recommend it.
Very nice. Then you moved into angel investment. And clearly you met entrepreneurs, and I think you were 10 years in the Bay Area, so clearly you were exposed a lot. But why angel investments? What was a trigger for you to get started and maybe some success, maybe some failures?
Yeah. So I wrote my first angel investing check in 2008, which was a really fun time to start angel investing. I wrote a $5,000 check, and it was to a very good girlfriend of mine. She had made a movie that promoted the awareness of mental health in the Asian community. Asians don't talk about mental health. They're like, "You're just sad, get over it," right? I did not know the term angel investing. I didn't know anything about venture capital. I knew nothing about the space. And I wrote the check, lost all of my money. But then all of a sudden, I was a quote unquote angel investor, and people started finding me and reaching out. And so, for a period of maybe 3 to 4 years, people would send me their deals. And I'd maybe look at 20 deals a year, and I'd maybe write 1 check per year. And most of those early checks were not successful. And then in 2012, 13, I realized that people need to learn what this meant. And I had learned a lot of this through my own mistakes. And I said, I'm going to get together a group of my friends and teach them what I've learned. And that was the start of 37 Angels.
Okay, very good. And then you started 37 Angels. So maybe you can describe what it is and why you started it.
Yeah, so I started 37 Angels with 2 goals in mind. The first was education, especially in 2012. Nobody knew what these terms meant. So I would go to these conferences and I would literally come home with pages of notes of terms I didn't understand. And I would go home and I would just Google everything. I would talk to everybody. I would ask all these questions. And I very quickly realized nobody knows what these terms mean. And nobody really knows, how do you diligence a company? How do you value a company? So I said, I'm going to try to teach again a group of my close friends, how do you actually do this? And so that was the first problem I was trying to solve, which was, how do I shine a light on the black box that is startup investing? And then the second thing is, I wanted to close the diversity gap. When I started angel investing, I was fairly young to be doing it. I'm an Asian woman, and I would walk into rooms and people would quite literally ask me if I was lost. Or they would ask me things like, where's your money from? Is your husband aware of what you're doing? And just all these crazy questions. So I said I wanted more people who looked like me to be investing in startups. And so 37 Angels, we activate new diverse investors through education.
Okay. And why is the number 37?
Yeah, when we started, only 13% of angel investors were women, and we wanted to close the gap from 13% to 50%.
Oh, that's a good number. Okay, now I get it. And talk about the performance of 37 Angels. How many investments? What was the returns over time?
Yeah, so every year we look at about 2,000 companies to invest in 10. And so we've invested in about 115 companies over just over 11 years. We have had over 50 investment boot camps that teach people how to do angel investing. We have had 3 IPOs and 16 acquisitions, and our portfolio internal rate of return is over 20%, which is in the top decile of performance. So our requirement to invest is that you have 6 months of customer data. It doesn't always mean revenue, although usually it does mean revenue, but so that tends to be seed stage. Although we do a little bit of pre-seed, we do a little bit of Series A, but the fat part of our bell curve is in seed stage. And we developed our diligence rubric of what we look for. We have the 4P framework: people, problem, progress, and price. And there are a lot of folks out there who are raising, who maybe shouldn't be raising angel and venture capital, or who aren't ready yet. And so it takes a lot of no's to get to that yes.
Okay. So maybe the tough question now. As you are invested from 37 Angels, if you had seen yourself when you started at 19 years old, would you have invested, yes or no, and why not?
100% no. And the main reason why is because we were a services company. So we were essentially an outsourced tech consulting firm. We were helping people with Java programming and Oracle DBAs. And so because we were a services-based company, we were not scalable, and so was not venture backable, nor did we try to raise venture funding at the time.
Okay, I understand.
And it's interesting, I would argue 20 to 25% of the companies that pitch us, what I tell them is, this is a great company. Go and run it. Don't raise any outside capital. Own 100% and just go build a really profitable company. You don't need to raise outside funding. You can grow through customer revenue. You can grow through grants. You can grow through debt. There are so many alternatives to angel and VC funding.
It's a golden nugget. And I love it because I keep saying it to many entrepreneurs I meet, including from France, where I said, unless you're planning to go very fast and you want to grow fast and you want to be very risky but potential very high outcome, don't go for VC money. And it's always surprise them coming from a VC to tell them that. But I think there are many good companies, very good business models that are just not venture type returns.
Absolutely.
So, what is your own bias as an investor? Clearly, you talked about people, problem, progress, pricing, so that's built into your bias. But when you meet the team, what it is that you're watching out for?
Yeah, so I think we have different biases by the different P's. On the people side, I have a real bias towards data-driven learners. And I think another bias I have is, I didn't come up with this, someone else said it, which is like hustle, not hassle, which is, I like good salespeople, and all investors want that founding team to be a good salesperson. But I do think that I have a visceral reaction for people who go too far down that salesy path. And sometimes they are fantastic founders. I also think, do I want to work with this person for the next decade? Yeah.
Okay, this is really good. You're looking at a proposition and decide if it's going to fit or not. And we talked about your bias for people. When you look at a deck, what is your biggest bias? So you haven't met the people behind it, you just look at the deck. What it is that is like, no way, and it's like, wow, okay, I want to deep dive.
Yeah. So the first thing, it's such a basic thing, is literally, do I understand the deck? And I know that sounds like such an obvious thing, but I am shocked at how many decks I get where I read, I'm like, I don't know what this company does. So that's the first thing is just literally, do I understand what they do? The second thing I look at is the team page. Is this the right team? And then I look for traction, right? So I am looking for rapid growth. And then I would say finally, I am looking for a deep understanding of the customer.
Like an unfair advantage from like the founder market fit concept.
So it's just something unique, right? It could be that they have strategic partners that are going to help them to penetrate this market better than anybody else. It could be that they grew up in the industry and so they know everybody in the space and they're going to be able to sell into their first 100 customers really easily. It can be that they have some interesting distribution channel that no one else has thought of. Like, I don't care what the unfair advantage is, but there has to be something that the team has that is going to let them win in the space. Because if it's a good idea, I've been pitched that idea 10 other times.
Yep, yep, and that's very fair. Now, let's talk about your exposure to corporate VCs. And I've heard you talking about corporate VCs, but you probably were exposed to them both as an entrepreneur, angel investor, and of course, you meet with them, I'm sure, in your class as your students. What's your view of corporate VCs and how do you think they are evolving over time?
Yeah. So corporate VCs are in about a quarter of all venture deals. And so it's important for all of us to understand because whether or not you work at a corporate venture capital firm or not, you will invest alongside them. So I think we'll start with the pros and then we can talk about the cons. So the pros of corporate VC is strategic value add, right? So if you are, like, I'll give you a great example of ZX Ventures, which was AB InBev's corporate VC arm. They don't exist anymore. But they were really good at helping beverage companies with licensing and distribution, which is very difficult in the US because it's all mandated on a state by state level and it's expensive. There was another one that they actually would help you. It was a life science VC, and they would help small companies get access to a wet lab, which is also incredibly expensive. So there's so much strategic benefit that can help on the corporate VC side. The other thing is it can open a lot of doors for strategic partners, right? So if they have relationships with Fortune 500 companies, that can open a lot of doors and that could be fantastic. So I think those are the pros of corporate VC. The biggest con I hear is speed, which is that corporates tend to not move at the pace of VCs and entrepreneurs. And so sometimes they can hold up deals. That can be one. And then the other thing is it can constrain your future fundraising and exit paths. So if a corporate VC does lead your Series A, sometimes in their term sheet, they can put in like a first right of refusal, which means that your Series B has to be led by them. And maybe from an exit perspective, they get to be the first ones to put an offer on the table. And so you're like really getting in bed with the corporate in the long term. And that could be another downside.
Yeah. So first, I think the conclusion from what you just said is yes, Mr. Entrepreneur do look into corporate VC because they bring some value, but be mindful of what you're signing up for.
Absolutely.
And you mentioned right of first refusal, which I think was something that quite a few corporate VC were asking a while back. I think it's decreased, but it's probably not zero. Can you share why this is so dangerous to have this? Because sometimes I hear, yeah, but they are getting value. So the entrepreneurs is getting a potential exit. The mothership is getting some guarantee. It's a win-win. But I think it forgets both the entrepreneurs and the other investors who are investing. So can you share about the right of first refusal and why this is so problematic for a corporate VC to ask for that?
Yeah, if you're at a point where you're ready to be acquired, right? It's very dangerous to have any whisper of acquisition value out in the market. And so you hear like, oh, whatever this corporate VC is valuing them at $100 million, right?
Mm.
That can really taint other acquisition offers that you might get. That's one. And then I think that there's also just like a feeling of, oh, if they're connected to this corporate VC, then sometimes a different corporate can almost start to see them as competitive. We had a portfolio company where a corporate VC led their Series A and their Series B, and when it came time to exit, it felt like that became the only option of who could acquire them. Thankfully, it was a good outcome, but I think as an entrepreneur, you want options. And having a corporate VC have a first right of refusal, it constrains your options. And at time of exit, that can mean lower exit valuations, Or if that deal doesn't go through, well, now you're in a really tough spot because it would have been harder to talk to other people. And I mean, it takes time, right? Like it's not like you have a conversation and you find out in a day that it's not going to work. That could waste 3 months, 6 months of your time. And that is a long time in a startup's life cycle.
Yeah, especially if you discuss it when you have 6 months run rate
Yeah,
left and it takes 3 months to get an answer, then you end up in a very tough spot.
absolutely.
Now, apart from right of first refusal, is there anything that you would say some corporate VCs have misbehaved and they should stop?
I don't know about misbehaving. I do think that a lot of corporate VCs and like corporate accelerators, I would lump into the same bucket. There's maybe like an overpromising where they will say, look, if you come join our accelerator or you take money from our corporate VC arm, that we're going to give you all this strategic help. We're going to open all these doors. And then when those things don't come through, I think that can be very frustrating for the founder. And I think that happens a lot, overpromising.
Yeah, I think setting the right expectations, not overselling. It's very hard because you do intend to bring all that strategic value. Whether you can deliver on it, that's sometimes actually probably all the time outside your control.
Yeah. I do hear whispers about like corporates doing it as a way to steal trade secrets. I don't see that happening a lot. I feel like founders are very afraid of that. Luckily, I've seen very little of that play out in the real world.
I actually don't think that's true. And if it's true, it's gross negligence because the risk to the mothership is so high.
Totally agree. But I
And
swear that founders are very afraid of it, but I don't think
yeah,
they mean
no, I understand the fear actually. I can imagine if you're very secretive of your project and you're talking to the CVC of a mothership that could compete with you in the future, you sharing with them is just, yeah, it feels dangerous. But in practice, in our case, we have a clear Chinese wall. And I keep explaining to the mothership the reason we have a Chinese wall is to protect you, mothership. Because if you end up getting trade secrets, from what we learned from startups, you're the one at risk. And you have to prove a negative in a court. You have to prove you didn't have the trade secret in the first place. It's very hard to prove a negative in court.
yes.
Now, what is there any CVC that you've worked with or you met which you thought, wow, they have a good design. This is something that others should learn from?
So the CPCs, I think, do a good job. They're very clear on their value add, right? So they were like, we will help you with distribution and licensing. I think Salesforce Ventures, there is a pretty clear path to M&A. So I think that about a third of what they eventually end up acquiring comes through their corporate VC leg.
And they were explicit about.
And it's very explicit, yeah. So I think it's just very clear, like the purpose of our CVC is to find acquisition targets, or the purpose of our CVC is to make money, which is what I would say Google Ventures does that very well. I think the ones who do it poorly are they're like, we do all of these things, but they do everything a little bit.
Setting expectation is critical. Now, you teach venture capital, so maybe I should ask this. What is a myth of your students believing something is true, and then when they go through your class, they're like, oh, wow, this is not what I thought?
So the first that comes to mind, and I feel like I should come up with a more interesting one, is that being a good VC is about picking really good investments. And while that is true, it's really important to source good investments, right? If you don't have good deal flow, you can be the best picker in the world. If you're picking amongst garbage, you're not going to get great stuff. I think another one would be that competition is bad. I think founders are really afraid of competition. Investors can be very afraid of competition. And I think one thing that we teach in our class is to have a much more nuanced view of competitive landscapes. There are markets where you can have a lot of winners. So, like, understanding competitive dynamics is really important as you're thinking about what is a good venture outcome in a space. And it's not just like competition is bad. I think it is something I try to disavow my students of.
That's a good one. I think, and it goes with market size. If the market is huge versus small, then it's where the competition doesn't matter as much. I think it was Lei Jun, the CEO of Xiaomi, saying something about even pigs can fly in a tornado, which I think basically means if the market is huge, you will be able to do well. But if you pick a market that's very, very small, then there's so little you can do. Now, let's talk about decision making, which hasn't come through. I mean, it's clearly part of diligence, but there's still a point in time where you need to decide to invest or not based on a diligence. And there will be times where it's not quite obvious. You could decide yes, you could decide no. What advice would you give for, especially corporate VC, where the decision making is typically very different, consensus based, lot of data? Here, typically, especially in seed or Series A, you don't have as much data, and maybe consensus is not going to help as much. So, how would you advise a corporate VC that's being designed right now to think about the decision making of an investment?
Yeah, so I think you have to very clearly define who, how, and when. So who is I think you need to constrain the who. I think there is a instinct with corporate VC that we're gonna have everyone make a decision. And I think that, Amazon has the 2 pizza rule, which is they don't kind of have working meetings with more people than can be fed by 2 pizzas. And I do think that having 25 people trying to make a decision is near and impossible, and frankly, I think leads to worse venture outcomes because it means that you're going to probably invest in the more obvious, less kind of innovative thing. So, constraining the who and, like, being very clear, like, we are deputizing these 5 people max, right, to make a decision. In terms of the how, I do think it's important for everyone to have some sort of rubric, right? So, these are the 14 things we care about, and we're gonna give each of them a score, and I would really encourage your score to be, like, on a scale of 1 to 4, not, like, 1 to 5. And the reason why is 'cause if it's 1 to 5, it's too easy to give everything a 3. But if it's 1 to 4, then it kind of forces people, like, "Do I like this or do I not like this?" And then have rules, right? So if more than one metric is below a 2, we can't invest. If the average is below a 3.2, whatever it is, like, having some sort of clear thing. And then recognizing that sometimes you throw the rubric out, right? So we have our rubric and we do try to have that. But I would say that so we write 10 checks a year. One check a year, I'm like, according to what's on this piece of paper, I either shouldn't be investing or I should be investing, but I'm going to make the other decision because that's what my gut says. And so allowing yourself the freedom to say that sometimes my gut is going to go in a different direction and I'm going to have the confidence to stick behind my gut, but you can't throw out the rubric all the time, right? So, like, saying, like, "But every year I get to make two dumb decisions," is fine, but every decision can't be made off of gut.
I really like it. That makes sense. What would be, and that's my final question, and maybe it's hopeful, which is what do you think is the role of corporate VCs to help entrepreneurs being more successful? What should they focus on to help entrepreneurs unlock value to society?
That's a big question.
Hmm.
Um, I would say that one is to share the wisdom of past failures. I think a lot of the times people talk about sharing best practices. I think sharing past failures and mistakes is so much more useful, especially for a founder. So that is one. And then I think the second is making expensive things less expensive by giving them a playground. The corporate VCs that do a good, really job is when there's something that's very difficult for a small company to do. So maybe it's access big data. Maybe it is to do like something that involves like a physical lab. Maybe that's something that involves doing a pilot with their customers. Because the power of corporates is scale and just massive access to resources. But the power of startups is this like nimbleness and this agileness. And if you're able to marry those two, magic is truly created.
Angela, thank you so much for your time today. And I think we touched many topics, but I think there was quite a few golden nuggets for the podcast audience. Thank you.
Thank you so much for having me.